Good afternoon and welcome to this edition of Finweek Money Matters. This is the show that helps you manage your finances. I'm Dumisho Greater. Coming up on the show today, we take a look at major megatrends that are currently changing the world, and we look at the prospects for luxury brands owner Richemont. We also have a panel of experts in studio with us. We'll be discussing life covers, who needs them and why. But before we get into all of that, do remember that we welcome your feedback and any comments. You can send it through to moneymatters@abn360.com. But first, let's take a look at the punt of the week. Swiss luxury goods group Richemont owns brands like Cartier, Alfred Dunhill and Montblanc. This is just to name some of a few of those brands. Now, despite remaining resilient through the global recession about a decade ago, the stock price seems to be dwindling in the past year, especially after the Richemont chair, Johann Rupert, announced last June that he was taking a sabbatical. The stock was sitting at around 113 Rand a share, almost a year now, and we are now sitting at levels of around 109 Rand a share. But joining me for more is our Finweek contributor, Moxima Gama. She joins us from our Cape Town studios. Moxima, thanks. Your outlook for Richemont?
Look, Richemont has been quite a good stock. I mean, personally, I bought it around the 17 levels and have enjoyed years of good returns and dividends. But as usual, when a stock starts to dwindle, you need to stop being greedy and sell it off. And it's starting to show signs of a bit of weakness, which just makes perfect sense. It's been rallying for quite some time now. It just really does need to correct before giving us a good buying position again for the long term. So we're seeing that symmetrical triangle form, as you could see on the chart there. And it is kind of still forming. It's at that 102 levels. But effectively, if it goes anything below 90 Rand, then that could be that would be a sign to start cutting or reducing your position and put your money elsewhere. On the flip side is if it goes above 109, then we could see it at least go up another at least 20 or 15%. But I would strongly suggest you still reduce your positions because it's overextended on the monthly chart, and you'd really want to still take in your profits. There are other stocks. It's just when it's rallied for so long, you really want to start looking into something else that would make you a good return like Richemont did.
Talking about good returns, Moxima, late last month we did see that merger between Net1 Porter and Yoox. What type of value can you expect this particular transaction to unlock?
Look, it puts Richemont in quite a big league. I mean, they're trying to form the biggest luxury or online luxury goods business, but they're going to own 50% of it and still at least keep 25% as voting rights. It's quite a good deal for them, and it does put them on a mark globally. But investors don't seem to be reacting to it. It was very mediocre reaction to it, which is just another sign, sign of caution. When investors are not reacting very well to, or rather very mediocre on good news, then it's a sign that you should start reducing. I mean, I'm not saying it's going to drop, but in order to maximize your profits, Richemont really needs to correct before we see another 5-year rally. At this point, it's formed that lower top, and that's just signs of weakness.
Moxima, thanks for that. That's the Finweek contributor, Moxima Gama. Up next, we'll be unpacking this week's trend of the week. There are currently 5 mega trends that are changing the world, and South Africa can learn a few lessons from this. This is according to megatrends expert, that's Dr. Van Beek. He's a member of the auditing firm PWC's global strategy and leadership team. But in studio with me to discuss more about these megatrends is Barry Vorster from PWC People and Change leader. Barry, thanks for your time. Let's talk about these trends. There are about 5. Maybe take us through some of them before we unpack them a little.
Okay, so just in terms of the trends and a little bit of the why as well. We did the research just to get a feel for what the context is for business, but also for the people, youngsters and youth, and to get a feel for what the world looks like. So a little bit about them: large demographic shifts, so an aging population in parts of the world, and a very young population in others. An additional large levels of urbanization, and we are seeing that all over the continent. Resource scarcity, and that includes power, like in South Africa.
Yes.
water to a large degree, especially if you're in Southern Africa. And I think the biggest one when it comes to our daily lives, and probably the most tangible, is technology breakthroughs. And if you look at them, they are cell phones. The usage of smartphones in Africa has risen substantially. Other tools, I kind of joke sometimes to say children who take photographs of their food rather than of other things when they're at restaurants, something I don't do specifically. One gets a feel for those larger mega trends, and within that we then try and understand what businesses need to do, but also individuals and the kind of youngsters who are now in the workplace.
Barry, one of the trends that definitely caught my attention is a shift of the global power. So your traditional powerhouses, your US. So right now, the growth is going to be coming from places like Asia, India, South Africa, or Africa. So with that, keeping that in mind, the rising middle class, how does South Africa capitalize on that? Are we really doing that?
So I think, just to put that into context, 50% of the rise in population growth globally will be in Africa. It's a large portion, it's about 500,000 people. Or 500 million, I mean. 500 million people in Africa. If one then extrapolates that, there will probably be a substantial rise in the middle class. That's a rise for retailers and banks. And I think we're seeing some of that happening in terms of the expansion of South African businesses. One also needs to contextualize that and think of the opportunities that open up with regards to the middle class in Africa, also in terms of mobile companies, in terms of television like you are already doing, and other opportunities that will open up around that. What I do suspect as well is that the type of world that we live in, so on the one hand you would have very large companies, but there would also be opportunities for smaller, innovative companies to make a real change in a continent like Africa.
Millennials, these are called Generation Y. Anybody that was born in the early 1980s to the early 2000s. Anyway, is there anything we can learn from them? If we're looking at the older generations, they'll probably be looking at us and say, can we learn from them? Is there anything that South African companies can latch on there?
I think we can. So I think there's several myths, but there are also a few truths about them. One specifically being is that they're probably not prepared to sacrifice as much as my generation was prepared to sacrifice in terms of time spent away from their families, in terms of the values that they espouse. And for them, they want to have real work-life balance. And in addition to that, I think more flexibility. Flexibility in terms of their reward, flexibility in terms of how we view them. And in addition to that, perhaps it's not so much about the differences they want, but the degree of importance. Okay. From our own research, we've seen that what they really want is more collaboration in the workplace, as well as higher levels of appreciation.
That sounds about right. Barry, thanks so much for giving us just a taste of those trends, millennials and mega trends. That was Barry Vorster from PWC's People and Change leader. Let's shift our attention now to this week's cover story. Improving the quality of education in South Africa's public schools could mean the difference between children growing up into functional or dysfunctional adults, making a major or minor contribution to the growth of the country's economy. For Finweek, we investigated the state of South Africa's public education system and some of the possible solutions. In studio to discuss this week's story is Finweek journalist Buhle Ndweni. Buhle, thanks for your time. What did you get out of the story? We always hear about how shocking the public system is, especially in black townships. Is this the case?
Yeah, it's very true. I mean, there is a crisis in South Africa. You get that there are 20,000 dysfunctional public schools in South Africa. And the problem now becomes that 5% of the children that actually go through the system, the public school system, will then, that's in grade 1 or grade R, they will, only 5% of them will actually go to tertiary level. And you will find that some of them that...
Sorry, 5%?
5%.
Okay.
5%, yeah. And you will find, I think, one of the contributing factors is that some of them are not functionally literate, you know? So if you can't comprehend what it is you're studying, it's very hard to study. The higher you go up the levels, you know, and there's no joy basically in studying. So that's what kind of fails the kids. And also the fact that some teachers are not passionate about teaching. They're just there to collect their salaries, and that's just mainly it.
Buhle, we're going to have to stop it at that, but for more on that, you can obviously get a copy of this week's Finweek. There is, however, are organizations that are there that can or are making a difference, and to see tangible difference in what it is that they are employing, get a copy of this week. Thank you so much to Finweek journalist Buhle Ndweni. We're heading into a very short break, but when we come back, we uncover life cover. Why do we need it? Stay tuned for that conversation. Welcome back. You're still with me right here on Finweek Money Matters. While many people believe that they have to take out a life cover in an event of a death, did you know that you may fall under the group of individuals who do not need to take out life cover? In studio with us to discuss this, we will be joined in just a little while. We'll have Schalk Malan, he's the Executive Director at Brightrock, and we'll have Vickie Lange from Alexander Forbes. But in Cape Town right now, we have Bruce Fleming. He's a certified financial planner. He'll be able to break down some of those issues in the meantime. Bruce, is it true? Are there really some people who fall into the category that they don't need to take out life cover?
Yes, hi to me, sir. Sure, there are. Typically life cover is a grudge purchase as it is. But people certainly that are a lot younger, that don't have debt, they don't have dependents that they might have to look after should they die. Typically those are the people that don't really need life cover. And then obviously people that have built up sufficient liquidity in their portfolios, that should something happen to them, their loved ones will be taken care of after their death, and the certain liabilities and estate expenses will be paid for from those assets.
In studio with me, as mentioned, I am now joined by Schalk and Vickie. Thank you so much. Schalk, let me start with you. Bruce was talking about that there is a certain category of people that don't necessarily need to take out life cover. But then you do get people that do. But, you know, it's a grudge purchase. If I'm heavily indebted, this is not going to be something that I'm going to rush out and buy. So what is the investment point or the argument point for somebody to go ahead and do this?
Hi. I think in terms of the point of buying life insurance, I mean, we always go back to say, if you look at what's your biggest asset for the man on the street, that's typically your income, your ability to generate an income, a future income. And in other words, you are your family's biggest asset, and you want to protect that. So a main reason for buying life insurance is if something would happen to you, for example, if you would pass away or you suffer a serious injury or illness, you want to make sure as a fundamental starting point that your future income is there for your dependents to care for them, or in the case when you're disabled, to also take care of them. So I think, you know, that starts, and then I think you always want to protect your assets as well, and that extends all the way through your income brackets in terms of people, because even if you're quite a wealthy person, you would still want to make sure that if there are additional costs, so for example, if you suffer from a serious injury or illness, you don't necessarily want to tap into your asset base. It's then great, and it's a very cost-effective way to have life insurance that would pay for those critical illness events and help and assist you in covering those costs. So our view at Brightrock is that, you know, there's various needs depending on you as a client, but those needs are definitely there, and it also grows as you have new change moments in your life. You know, as you get new debt, incur new debt, as that new child comes into your family, you'll get your first salary increase. Those are change moments, and you want to make sure that your product actually, you have life cover to protect that.
Vickie, let's bring you into the conversation. I'm not endorsing any particular product, but in my mind there's always this ad that comes up saying how much is enough. So I think that's a key question. If you're putting away money, this is supposed to be life cover. As Schalk says, you want to protect your family. How do you know how much you need to put away?
Yeah, so that's quite a challenging question to actually answer. At the end of the day, everyone is different. You have different personal circumstances, and so it's difficult to you know, just give you a rule of thumb out there. But I think the biggest factors that you need to look at is your level of debt, your dependency status. So a big factor, for example, is your spouse actually working or not, because that will determine, have a big impact on the level of cover that you need to look at. Also, people often forget in your retirement fund you've accumulated a certain amount of savings, and that's available as a pot of money to distribute to your legal and financial dependents should you pass away. So sometimes people quite often actually forget about the accumulated savings that they have in their funds.
Bruce, let's come back to you in Cape Town. The products that are on the market at the moment, do you need a lot of different products to cover all these needs? Are we finding that in the market right now there is one product that will be able to cater to this?
Yeah, I think you don't need to make it overly complicated. Life cover is life cover. And so if you've got one life cover or sufficient life cover to cover things like your debts, your liabilities, capitalize your income, as Schalk said earlier. You capitalize your income for however long you need your income to last. You can wrap that all in one bit of life cover. To have 4 or 5 different life covers, I think it's not necessary.
Schalk, you're nodding there.
Yeah, I think I can maybe add to that, or a slightly different view as well. Perhaps is that one should, you know, in terms of looking at a client and understanding and unpacking the reasons for buying that life cover, it's critical to unpack what are the reasons for having bought that life cover. If you look at those, for example, debt, income, your children's education, and the thing that we found at Brightrock in our research is that each one of those needs perform very differently. So, for example, your debt would run a shorter duration. That's, for example, something that you need to cover your estate duty, or your income needs are much longer than your debt as well, or even for your children's education, it is also a very different shape and duration. And what we've actually designed is a product that really looks at your various needs and then allocate your premium and your cover to those specific needs. And the result of that is a more efficient, more effective product, as opposed to grouping everything together. And I think a great analogy is like that, you know, buying the CD where you like two or three songs, as opposed to buying those iTunes where you're actually buying what you need, as opposed to buying the bulk thing and you only actually like 2 songs out of that CD. And I agree with, you don't want to overcomplicate things, but there are product platforms now available that actually